Hello everyone. Today we will learn about operating ratios. Operating ratios, also called activity ratios or the management ratios, indicate the efficiency of the company's operational activity. To some degree, the operating ratios reveal the management's efficiency as well. These ratios are called the asset management ratios, as these ratios indicate the efficiency with which the assets of the company are utilized. Some of the popular operating ratios are fixed asset turnover ratio, working capital turnover ratio, total asset turnover ratio, inventory turnover ratio, inventory number of days, receivable turnover ratio, days sales outstanding, that is DSO. The above ratios combine data from both the P&L statement and balance sheet. We will understand these ratios by calculating them for Amara Batteries Limited. To get a true sense of how good or bad the operating ratios of a company are, one must compare the ratios with the company's peers or competitors, or these ratios should be compared over the years for the same company. Fixed asset turnover ratio. The ratio measures the extent of the revenue generated in comparison to its investment in fixed assets. It tells us how efficiently the company uses its plants and equipment. Fixed assets include the property, plant, and equipment. Higher the ratio, it means the company is effectively and efficiently managing its fixed assets. Fixed assets turnover is equal to operating revenues divided by total average asset. The asset considered while calculating the fixed asset turnover should be net of accumulated depreciation, which is nothing but the net block of the company. It should also include a capital work in progress. Also, we take the average assets for reasons discussed in the previous video. From ARBL's FY14 balance sheet showing that is equal to 767.864 plus 461.847 divided by 2, that is equal to 614 crores. We know the operating revenue for FY is 3,436 crore rupees. Hence, the fixed asset turnover ratio is 3436 divided by 614, that is equal to 5.59. While evaluating this ratio, do keep in mind the stage the company is in. For a very well established company, the company may not be utilizing its cash to invest in fixed assets. However, for a growing company, the company may invest in fixed assets and hence the fixed assets value may increase year on year. You can notice this in case of ARBL as well. For the FY13, the fixed asset value is 461 crore rupees, and for the FY, the fixed asset value is 767 crore rupees. This ratio is mostly used by capital intensive industries to analyze how effectively the fixed assets of the company are used. Working capital turnover. Working capital refers to the capital required by the firm to run its day-to-day operations. To run the day-to-day operations, the company needs certain types of assets. Typically, such assets are inventories, receivables, cash, etc. If you realize these are current assets, a well-managed company finances the current assets by current liabilities. The difference between the current assets and current liabilities gives us the working capital of the company. Working capital is equal to current asset minus current liabilities. If the working capital is a positive number, it implies that the company has working capital surplus and can easily manage its day-to-day operations. However, if the working capital is negative, it means the company has a working capital deficit. Usually, if the company has a working capital deficit, they seek a working capital loan from their bankers. The concept of working capital management in itself is a huge topic in corporate finance. It includes inventory management, cash management, debtors management, etc. The company's CFO Chief Financial Officer strives to manage the company's working capital efficiently. Of course, we will not get into this topic as we will digress from our main topic. The working capital turnover ratio is also referred to as net sales to working capital. The working capital turnover indicates how much revenue the company generates for every unit of working capital. Suppose the ratio is 4, then it indicates that the company generates rupees 4 in revenue for every rupees 1 of working capital. Needless to say, higher the number, better it is. Also, do remember, all ratios should be compared with its peers or competitors in the same industry and with the company's past and planned ratio to get a deeper insight of its performance. The formula to calculate the working capital turnover is equal to revenue divided by average working capital. Let us implement the same for Amar Raja Batteries Limited. To begin with, we need to calculate the working capital for the FY13 and FY14 and then find out the average. Here is the snapshot of ARBL's balance sheet. I have highlighted the current assets in red and current liabilities in green for both the years. The average working capital for the two financial years can be calculated as follows. We know the revenue from operations for ARBL is 3437 crores. Hence, the working capital turnover ratio is 3437 divided by 672 is equal to 5.11 times. The number indicates that for every rupees 1 of working capital, the company is generating rupees 5 in terms of revenue. Higher the working capital turnover ratio, the better it is, as it indicates the company is generating better sales in comparison with the money it uses to fund the sales. Total assets turnover. This is a very straightforward ratio. It indicates the company's capability to generate revenues with the given amount of assets. Here the assets include both the fixed assets as well as current assets. A higher total asset turnover ratio compared to its historical data and competitor data means the company is using its assets well to generate more sales. Total asset turnover is equal to operating revenue divided by average total assets. The average total assets for ARBL is as follows. Total assets for FY13 is 1770 crore rupees and total assets for FY14 is 2139 crores. Hence, the average assets would be 1954 crore rupees. Operating revenue for FY14 is 3437 crores. Hence, total asset turnover is 3437 divided by 1954, that is equal to 1.75 times. Inventory turnover ratio. Inventory refers to the finished goods that a company maintains in its store or showroom with an expectation of selling the finished goods to prospective clients. Typically, the company, besides keeping the goods in the store, would also keep some additional units of finished goods in its warehouse. If a company is selling popular products, then the goods in the inventory get cleared rapidly, and the company has to replenish the inventory time to time. This is called inventory turnover. For example, think about a bakery selling hot bread. If the bakery is popular, the baker probably knows how many pounds of bread he is likely to sell on any given day. For example, he could sell 200 pounds of bread daily. This means he has to maintain an inventory of 200 pounds of bread every day. So, in this case, the rate of replenishing the inventory and the inventory turnover is quite high. This may not be true for every business. For instance, think of a car manufacturer. Obviously, selling cars is not as easy as selling bread. If the manufacturer produces 50 cars, he may have to wait for some time before he sells these cars. Assume to sell 50 cars, he will need 3 months. This means every 3 months he turns over his inventory. Hence, in a year, he turns over his inventory 4 times. Finally, if the product is really popular, the inventory turnover would be high. This is exactly what the inventory turnover ratio indicates. The formula to calculate the ratio is inventory turnover is equal to cost of goods sold divided by average inventory. Cost of goods sold in the cost involved in making the finished goods. We can find this in P&L statement of the company. Let us implement this for ARBL. To evaluate the cost of goods sold, I need to look into the expense of the company. Here is the extract of the same. Cost of materials consumed is 2101 crores and purchases of stock in trade is 211 crores. These line items are directly related to the cost of goods sold. Along with this, I would also like to inspect other expenses to identify any costs that are related to the cost of goods sold. Here is the extract of Note 24 which details other expenses. There are two expenses that are directly related to manufacturing, that is, stores and spares consumed, which is at 44 crores, and the power and fuel cost is at 92 crores. Hence, the cost of goods sold is equal to cost of materials consumed plus purchase of stocks in trade plus stores and spares consumed plus power and fuel. That is equal to 2101 plus 211 plus 49 plus 92. Therefore, COGS is equal to 2449 crore rupees. This takes care of the numerator. For the denominator, we just take the average inventory for the FY13 and FY14. From the balance sheet, inventory for the FY13 is 292 crores and for the FY14 is 335 crores. The average works out to be 313 crores. The inventory turnover ratio is equal to 2449 divided by 313, that is equal to 7.8 times, that is roughly 8 times in a year. This means Amar Raja Batteries Limited turns over its inventory 8 times in a year or once in every 1.5 months. Needless to say, to get a true sense of how good or bad this number is, one should compare it with its competitors' numbers. Inventory number of days. While the inventory turnover ratio gives a sense of how many times the company replenishes their inventory, the inventory number of days gives a sense of how much time the company takes to convert its inventory into cash. Lesser the number of days, the better it is. A short inventory number of days number implies the company's products are fast moving. The formula to calculate the inventory number of days is equal to 365 divided by inventory turnover. The inventory number of days is usually calculated on a yearly basis. Hence the formula above indicates 365 number of days in a year. Calculating these for ARBL is equal to 365 divided by 7.8, that is equal to 46.79 days. This means ARBL roughly takes about 47 days to convert its inventory into cash. Needless to say, the inventory number of days of a company should be compared with its competitors to get a sense of how the company's products are moving. Now here is something for you to think about. What would you think about the following situation? A certain company under consideration has a high inventory turnover ratio. Because of high inventory turnover ratio, the inventory number of days is very low. On the face of it, the inventory management of this company looks good. A high inventory turnover ratio signifies that the company is replenishing its inventory quickly, which is excellent. Along with the high inventory turnover, a low inventory number of days indicates that the company is quickly able to convert its goods into cash. Again, this is a sign of great inventory management. However, what if the company has a great product but a low production capacity? Even in this case, the inventory turnover will be high and inventory days will be low. But a low production capacity can be a bit worrisome as it raises many questions about the company's production. Why is the company not able to increase their production? Are they not able to increase production because they are short of funds? If they are short of funds, why can't they seek a bank loan? Have they approached a bank and are not being able to raise a loan successfully? If they are not able to raise a loan, why? What if the management does not have a great track record, hence the bank's hesitation to give a loan? If funds are not a problem, why can't the company increase production? Is sourcing raw materials difficult? Is the raw material required regulated by government like coal, power, oil, etc.? Difficult access to raw material. Does that mean the business is not scalable? As you can see, if any of the points above is true, then a red flag is raised. Hence, investing in the company may not be advisable. To fully understand a production issue, the fundamental analyst should read through the annual report from the beginning to the end. This means whenever you see impressive inventory numbers, always ensure to double check the production details as well. Accounts receivable turnover ratio. Having understood the inventory turnover ratio, understanding the receivable turnover ratio should be quite easy. The receivable turnover ratio indicates how many times in a given period the company receives money from its debtors and customers. Naturally, a high number indicates that the company collects cash more frequently. The formula to calculate the same is accounts receivable turnover ratio is equal to revenue divided by average receivables. From the balance sheet we know trade receivable for the FY13 is 380 crores, trade receivable for the FY14 is 452 crores. Average receivable for the FY13 is 416. Operating revenue for FY14 is 3437 crores. Hence the receivable turnover ratio is 3437 divided by 416, that is equal to 8.24 times a year. This means ARBL receives cash from its customer roughly about 8 times a year or every month and a half. Day sales outstanding DSO or average collection period or day sales in receivables. The day sales outstanding ratio illustrates the average cash collection period, that is the time lag between billing and collection. This calculation shows the efficiency of the company's collection department. Quicker the cash is collected from the creditors, faster the cash can be used for other activities. The formula to calculate the same is day sales outstanding is equal to 365 divided by receivable turnover ratio. For ARBL, it is 365 divided by 824, that is equal to 44.29 days. This means ARBL takes about 45 days from the time it raises an invoice to the time it can collect its money against the invoice. Both receivables turnover and DSO indicate the credit policy of the firm. A efficiently run company should strike the right balance between the credit policy and credit it extends to its customers. In this video, we have completed analysis of operating ratios. In the next video, we will learn about valuation ratios. Thank you for watching this video. Please do like, comment and share this video to your friends and family members. Also, don't forget to subscribe my channel.